Welcome back to what has been the first video in quite a while, but this time we're going to be talking about something slightly different. We're going to be having a look at the opinions of somebody who is quite popular in the realm of markets. Of course, this is going to be a video centered on Michael Burry and what he thinks based on what we're seeing in the current market. So if you enjoy this sort of content in opposed to what we normally do subscribe, of course, and we can make more of this sort of stuff. Again, I did want to try something new. Hopefully it works. We're going to be trying a few of these, hopefully, and again looking at what is going on in the market as of current, because things are changing. Anyway, so this one's going to be a bit more of a presentation. We're going to be looking through Michael's opinion, looking through what the facts say, and then combining it at the end. If you enjoy this sort of thing, do subscribe. So we're going to work our way through the slides and see where we go. First slide. Now this is going to be something which most of you will know, but this is just a quick summary on who Michael is. So Michael Burry, who is he? Most have an idea on who he is. Like I said, he's an American investor and hedge fund manager. I highlighted mainly the main parts in colours. So yeah, he's a hedge fund manager, best known for being amongst the first investors to predict and profit from the mortgage crisis, which of course occurred between 2007 and 2010. So right now what we're seeing is Michael Burry saying that he believes that an economic winter is incoming. Now this is all cited from the Daily Hodl. And it says this: so a document filed by Michael Burry's Scion Assessment Management, I believe it is, with the US SEC has basically shown that he holds one stock, and this is as of the second quarter of 2022. Now the reason why this is so key is because he has sold 11 stocks. In the first quarter he owned 12 stocks. So we can see he's reduced significantly the amount of companies he invests in. So we can see a few of the names which he has liquidated shares in. So his shares have been liquidated in Warner Bros, Sportsman Warehouse Holdings, and others which you may have heard of. You know, some real big names in there, such as Alphabet and Meta Platforms. So now he only holds 3.3 million worth of shares in Geo Group, a company that invests in private prisons and mental health facilities. Really interesting that he chooses to invest in those solely. Again, we can kind of infer as to why that may be, but it would just be a speculation. But if we think about why, potentially it's the fact that these companies are always useful, they always are needed. Again, not necessarily recession proof, but some companies, and again I'm not saying which ones, some companies are quite a bit more resilient because of their fundamentals in recessions than others. Anyway, so this is a quick summary and a screenshot which I took as to who Geo Group actually are. So who we are, this is on their site and it's under their About Us section. Geo provides complimentary turnkey solutions for numerous government partners worldwide across a spectrum of diversified correctional and community re-entry services. From the development of state-of-the-art facilities and the provision of management services and evidence-based rehabilitation to the post-release reintegration and supervision of individuals into the community, Geo offers a fully diversified, cost-effective service that delivers enhanced quality and improved outcomes. So again, it talks about what they do in their words. Again, somewhat of a correctional facility, as was said before. You know, they invest in prisons and of course mental health facilities. So again, if we wanted a bit more of a summary as to what they actually do word for word based on their interpretation, well, there you go. Again, now moving on to the why. Why now? Why has Michael chosen to do this now? Why is now such a key time for him, and why has this kind of, you know, swayed his mind? So what we're seeing now in the markets is this. So his commitment comes as a Federal Reserve Bank of New York Center for Microeconomic Data reveals now the total US household debt now stands at 16.15 trillion. That's up by 312 billion or 2% from the second quarter, or rather in the second quarter of 2022. Mortgage balances, the largest component of household debt, well, that's climbed by 207 billion and it stood at 11.39 trillion as of June the 30th. Now these figures of course are rising quite dramatically. Again, these increases, 2%, it may sound incremental, tiny, infinitesimal, but in actuality, no, that is a big increase. And again, we can look back to the past as to what happens when things like the household debt level starts to rise, when things like mortgage balances start to rise as well. And when credit card balances again see the same thing. So what we're seeing here now is credit card balances saw their largest year-over-year percentage increase in more than 20 years. We are also seeing that aggregate limits on credit cards mark the largest increase in over 10 years. Transactions into delinquency ticked up but remained low, very low compared to historical levels. So that's one thing which we could see and interpret, but realistically, in my personal opinion, this is all quite significant. Again, we've seen in the past, look back to 2008 and around that time, what happens when we see household debt increase, when we see mortgage balances increase. Are we looking at the potential for a crisis? Are we looking at the potential for a crash? Well, inevitably, Michael thinks so. Now, moving on to our next slide, this is going to be a summary as to what we are seeing in the markets in the past month. So, what we're seeing now is some market rallying in the past few weeks. It's easy to think that the market decline is over, but we cannot interpret the past scenario directly, and again, that's what I was talking about in the previous slide. We cannot necessarily interpret it as a one-to-one example, saying that this happened in 08, therefore we're going to crash right now, but we can use the history as a guide as to what may happen. So again, this chart down here is looking at the US markets. And what we're seeing, generally speaking, on a lot of the indices now, it doesn't matter which one you look at, the S&P, the Nasdaq, or the Dow, we're all seeing something pretty similar. Again, some moving up a bit more, some moving up a little bit less. But really, from February, we're seeing this decline, coming down very, very steeply. We saw a bit of an increase, fair enough, and then we saw this period where we inevitably look like we may have found the bottom. And this has a lot of people thinking, well, this is over. Well, if we have a look at this, yes, it does look like it could be a bottom, and it looks like we are rallying, but do not be fooled. Zooming out to the larger picture, we get a bit more of an interpretation as to what is really going on. And this is coming up to the end of the video. Again, I'm trying to keep this one quite short, but I do want to focus on the main things that we need to look at to have an understanding of this situation. So this is going to be the longer part of the video because whilst we have less to talk about on paper, I do want to infer a lot of stuff. So yeah, going back to the previous chart first. Again, we're seeing this increase which I have highlighted in this bubble. Coming over here, we're going to be seeing what happened in historical events such as 08. Now, looking back to 2008, the recession originally began. After a long market rally, we can see that. Coming in after that, we saw an official recession confirmed. This was after quite a steep decline, and at that point, we have to think, oh, well, where's this going to go? It looks like, well, the recession's confirmed. We saw a slight uptick, and again, this is looking on a chart which spans almost 20 years. So again, looking at this on a more close scale, perhaps a 1, 2, 3 month chart back to 08, we're going to be seeing something which looks a bit more significant. So yeah, we're seeing that small rise, and after that, people may be thinking, well, it's coming to an end, but actually, what we saw is we saw a massive dip as the recession becomes something which we are all feeling. Now, looking up to what we're seeing in 2020, because that's when all of the more interesting stuff that we're seeing now really started to commence. Obviously, we saw a big market rally from basically 2010 all the way up to 2020. It's a 10-year really bullish market, to be honest with you. And then we saw COVID come along. Now, of course, when COVID came, crash, we all saw everything decline. Now, looking back to history, it wasn't that big of a dip, really. But, at the unprecedented time that we were at, it was quite a large decline. Now from there we had stimulus and all that sort of stuff, all really stimulating the economy as you would expect. And we saw the economy and the markets subsequently hit new highs. Now after those new highs, the question is, where do we go? Now of course we know, unfortunately, runs like this are long-term unsustainable. And especially when we look back to the data that we are seeing, such as this, household debt rising, mortgage balances rising, it all adds up, and we all see this one come together. And now that the recession is in a state where it is coming to be confirmed, well, where do we go? Again, it's not looking like we are in a situation where we're going to be seeing bullish things happen, when all of the fundamentals which would make a bull run happen are just lacking. We're seeing inflation rise, we're seeing household debt rise like I keep going on about, and all of this sort of stuff is going to be having that impact. So don't underestimate it. Like he said, it's very easy to look at things like this, where we saw rises here, where we saw rises here. I'm not saying it's going to be a one-to-one repeat, but we are not at the highs that we were at prior, so we're not necessarily out of this hole. And again, whilst this is just my opinion and Michael's opinion combined realistically, pros can get it wrong, but it doesn't really take long to look at the evidence, do your due diligence, and work out what you think is going to happen. Again, it's for you to make the call, but this is just my personal interpretation based on what I am seeing. So to sum things up very quickly, we're in a place where the markets have been rising throughout July coming into August. Now we're starting to go back down quite steeply again. And the question is, where do we go? Again, the fundamentals not looking too cheerful if you ask me, unfortunately. And I think it's very early to say, at the best case scenario, that the market decline is over. So you should definitely do what you think is right. This is just what Michael is saying. I just wanted to bring you one of these opinion related videos, as I do quite enjoy researching these sorts of things. Again, it wasn't the best presentation, but I did what I could with this one, guys. Again, if it does do better than our ordinary style of content, perhaps I can make these more analytical videos coming at you every now and again. So if you enjoyed, of course subscribe, share it with a friend, and I'll see you in our next one.